This question we are going to practice is summer 2020, that is May June. Question number 1, part A and part B. This is from unit 2. Okay, so in this question we can see Bilal is a trader. He buys goods on credit and for cash. He sells goods on cash basis only. So what we can see here is while he buys on credit, he sells on cash. Okay. So the following transactions took place in April 2020. Bought goods on credit. So this is a purchase. So objective here is to determine what are the purchase entries and what are the sales entries. Bought goods on credit. Again, a purchase. Bought stationery, paying by check. So remember, we are recording this is a purchase, but this is a expense because stationery is not a trade-in good. What goes to now, if you look at the question is asking us to prepare a purchase journal. The purchase journal is the book of prime entry which records all credit purchases, all credit purchases of trade-in goods. Now this term you guys are familiar with. What when I say trading goods, you guys are familiar with this term. Okay, so trade in goods, that means what the business is. You have to look at the business as trading activity, figure out what the trading goods is. So for example, the trading goods for bookshop would be books. If you take a bakery, it is the raw materials that they buy in order to manufacture or make or bake the items that they're selling. So that can be flour, eggs, gas, not gas per se, but yeah, let's say mainly flour, eggs, direct raw materials, butter, things that they use in order to produce the items, any meat that they buy in order to fill into the items. So if you take a furniture selling shop, their trading goods will be the actual furniture that they're buying. Okay, so remember, you don't record all purchases in the purchase journal. You only record credit purchases of trade-in goods. Understood? So that both is important. And here it says bought goods. These are trading goods. That's how the examiner is indicating that these are trading goods. So these both go to the purchase journal. Okay, so I'm just going to actually, to make it easier, I'm just going to highlight the transactions that go to the purchase journal. Okay, so definitely April 4th transaction and April 5th transaction. Next, April 6th, bought stationery of 145, paying by check. First thing is this: if you're paying by check, that means it's a cash transaction. Cash transactions do not go to the purchase journal. Okay, so for items to go to the purchase journal, there are two conditions that need to be met. It has to be a purchase of a trading good, and it has to be on credit basis, which means you did not pay at the moment you purchased items. You pay it on a later date. So in this transaction, immediately you should be able to identify that if you paid by check, it's a cash transaction. So that's one condition is not met. So definitely it cannot go to the purchase journal. The next item we need to see is if they bought stationery. That is not a trading good of the business. I know over here in this instance they haven't explained what type of company it is, but usually in general stationery is always an expense used in operations of a business, to help with the operations of a business. So this does not go to the purchase journal. Okay, next we'll move on. Cash sales, cash transaction, sales not in the purchase journal. Paid $128 to Millie, again cash transaction. So we have here 3 cash transactions, which means these go to the cash book, not to the purchase journal. It doesn't meet the conditions. Next, we have cash sales. Oh, okay, so this is also cash transaction. We have a few cash transactions because probably the question, yep, as you can see in part B, the question is asking you to make a cash book. So these are the entries that will definitely go to the cash book. I'm going to put a tick in front of the entries that go to the cash book and not to the purchase journal. Bought goods on credit from Todd, who offers a 4% cash discount for payments made within 14 days. We have bought goods on credit from Todd. This is definitely going to the purchase journal. So this is the purchase journal entry. This is a purchase journal entry because you can see this is a credit transaction and you have bought goods, so that means trading goods. We do not care about the cash discount area, because that at the point where a cash discount is given at the point where sale is made. So we really don't need to care about that. I mean, not at the point the sale is made, when the payment is made. Sorry, my bad. So we don't need to care about that. Okay, we only need to care about trade discounts when you're recording the purchase journal. Okay, because remember, in accounting we only record net amounts. So net amounts is basically listed price minus trade discounts. You see, you can see here listed price. Over here there is no trade discount, so this will be the net amount. Okay, next, bought office equipment paying by bank transfer. Again, this is a cash transaction, so it goes to the cash book. Okay, and office equipment is not a trading good. Office equipment is the purchase of a non-current asset, therefore it doesn't go to the purchase journal. Paid check for the goods purchased on top after deducting the cash discount. Again, cash transaction, doesn't go to the purchase journal. Paid 485, again cash discount transaction, goes to the cash book. Sold office equipment for $50 cash book. So what we can see here is we have 1, 2, 3 entries that go to our purchase journal. So now they're given us the format of the purchase journal, and it's fairly simple. So under the date, you put the date of the transaction. So 4th of April. Under details, you put the name of the supplier, that is, who did you buy goods from. So in this instance, on the 4th of February, 4th of April, we bought items from Millie. And remember, I told you in accounting we always only record net value, not listed price. So every time you see listed price and trade discount, what should you do? Reduce the trade discount. So we have 320. Find the value of the trade discount, which is basically 3.2 times 20. So we added 32 times 2 is 64. So the net value of the transaction is 320 minus 64. So 320 minus 64 is 44 minus 300, 356, 256. So the value is 256. That's the first transaction. Next transaction we'll see. Okay, when did it happen? On the 5th of April. And we have EHL Limited. We have purchased from EHL Limited. There is no listed price or trade discount, so we take the full amount, 500. And then finally we again bought goods on credit from Todd. That is on the 13th of April. Todd, we bought goods on credit from him for $250. Got it? So this is our total credit purchases for the month. So 750 plus 2, that will give us 1006. And it says total, indicating the ledger account to which the total will be posted. So the purchase journal records all credit purchases, and all credit purchases are transferred to our expense account called the purchases. So transfer to debit side, because an expense is a debit entry. Debit side clear. So that's part A. Let's move on to part B. They're asking us to prepare Bilal's cash book. Okay, so as I said, any ledger account you have to look for opening and closing balances. And in this transaction, in this list of transactions, I can see that there are no opening balances given. Okay, so let's identify the transactions that go to the cash book. I will underline them in red. Okay, so bought stationery by check, cash sales, paid Millie, cash sales. This transaction no. Bought office equipment, yes. Paid check, yes. Yes and yes. So we have 1, 2, 3, 4, 5, 6, 7, 8 entries that should go into our cash book. So first we'll see if there's an opening balance given. There is no opening balance given. So what we will do is we'll start off with our transactions. So let's take the first transaction. The first transaction that will go to the cash book is bought stationery of 145 by paying by check. Okay, now this is important. Okay. Oh, they're giving us the opening balance. over here the transaction is already filled. Okay, so it's simple. Okay, so on the 6th of April we bought stationery for 145 paying by check. So on the 6th of April we bought stationery paying by check worth $145. Since you paid by check, it will be on the credit side. We paid, cash balance decreases. Remember, this is an asset account. Okay, so debit entries increase the value of assets, whereas credit entries decrease. So when we pay by check, the balance in a bank account, we had 1960 in our bank account, 160 as at 1st of April. The balance decreases. How do you decrease an asset? Is a credit entry. We bought stationery, which is an expense, so the double entry will be debit stationery and credit cash book 145. Next, cash sales 280 were paid immediately into Bilal's bank account. So we had cash sales. So you sell goods, which means you get money. So your cash balance increases. So that will be a debit entry in the cash book, 280 on the 8th of April. Again, this was deposited into the bank account. So 8th of April, it's a sale, cash sale. So that's a sales account. The value is 280 if I'm not mistaken. Yes, it was deposited into the bank account. So debit entry there. So both these entries are done. Next, we paid $128 to Millie. Okay, so it doesn't say paid by check, which means it's paid by cash. Okay, so we paid $180, $128 to Millie. So when you pay, what happens again? Your cash balance decreases. On the 10th of April, we paid Millie. So first thing is, it's in the cash balance account. It decreases by 128, and we paid Millie, which means our trade receivable our trade payable Millie will decrease. This is a trade payable account, person that we bought from. That entry is done as well. Again, we have cash sales of 110 on the 12th. So it says cash sales, which means the money wasn't deposited in bank account. It was deposited into a cash. So our cash balance is what increases, not the bank balance. So that is 110. That's right. So we have $110 here. Next, bought goods on credit from Todd, that goes to the purchase journal. Bought office equipment of $500 paying by bank transfer. That means you transfer money from your bank account. The balance that decreases is your bank account. So on the 17th of April, we bought something for $500. Yes, and paid by bank. So our bank balance is going to decrease by $500. And what did we buy? Office equipment, which is a non-current asset. So we had to prepare a new ledger account called office equipment and record it there. You debit office equipment because you obtain an asset, the asset increase. You paid for it by bank, so your bank balance decreased by 500. So that's the transaction there. Okay, paid by check for the goods purchased from Todd on 13th April. So we bought items. What did we buy from Todd on 13th April? What's the value? 250. You have a 4% cash discount. So this is on the 21st. We paid Todd. So what you need to understand is Todd is a supplier and a current liability. When we pay him, his amount decreases, the amount we owe. So liability decreases with the debit. And remember, you paid by check, which means your bank balance is going to decrease. We had to just calculate how much. So the value of goods purchased on the 13th of April was 250. But since there's a discount, we had to take into adjustment the cash discount, which is 4%. So first we'll find the value of the discount. So this divided by 100 into 4, so that is 2.5 into 4, which is basically $10. 2.5 times 100. So this is $10. That's the cash discount. So Todd is a supplier. You bought items from him, so therefore this is a discount received, $10. So then actually how much did you pay, Todd? 250 is how much you had to pay. You paid 10, which means you only paid $240. Okay, so our double entry here, this is when we only record the cash entry here. So you paid a check on the 21st. The value of that check is going to be only $240. So in Todd's account, have to put the value, which is $240. Remember, over here the cash book acts as a book or prime entry for discounts. It's not double entry, it's only listing it as information, so that we can identify that when we made this payment to Todd we received a discount of $10. The double entry to record a discount received would be debit the Todd's account, the current liability account, and credit discounts received because it's an income. So that is done. Then we have a payment to EHL by telephone transfer. Telephone transfer also means a bank transfer, having deducted 3% cash discount. So EHL is the next supplier. We have paid $485, having deducted a 3% cash discount. So now here we have to double check and see what my confusion or what my understanding would be is, have we paid $485 after deducting the discount or before deducting the discount? So based on what I see is $485 was paid after obtaining the discount. So let us double check it. My assumption is that this $485 is before the discount. So yes, it is, because see, $500 we owed EHL, and we have only paid $485 in settlement. We have got a 3% discount, so that means 500 into 3% is 15. So we have paid EHL Limited on 24th. We owed EHL Limited 500. That was mentioned there. So EHL Limited, we paid them how much? $485, which means we got a discount of $15. And then finally we have sold old office equipment of $50 on cash. You sell office equipment, you receive money into your bank account. Sorry, they've sold it for cash, so it will be the cash account, which means sold office equipment for $50 under 28. Office equipment decreases because we sold it, the value of assets decrease, so credit office equipment and debit cash book $50. Okay, so next step is simply balancing our ledger accounts. So we put the total rows for each ledger account. So this is 25 and this is 0. We have a cash balance of 160 on this side, and that is obviously higher than 180, 160. So we'll balance the ledger account 31st April, 30th April balance carried down, which is $32. So we'll have a balance brought down in our cash account on the 1st of May of $32. Next, okay, so clearly a bank account is higher on the debit side, so that is 1960 plus 280, 80 plus 60 is 140, 1900 plus 200 is 2100, 2100 plus 140 is 2240. Obviously it has to be higher than this side. Let's see. So 145 plus 485, let's see, 145 plus 485, 585 plus 620, 630, that is, yeah, 630 plus 500 is 1130 plus 240, 1370. Yes, 1370 minus 2240, which gives us 870. So this is our closing balance. So that is part A and part B done for y'all. I hope you go through the videos and attempt these questions. Everything I've explained here is fairly simple and we have done everything, so I hope y'all kept up. If you have any inquiries, message me. Thank you.